This is one of the most important things you're going to hear about what they're going to do if a big bank fails.
These are some of the unique challenges that we see from a resolution perspective when considering large banks, and would be interested to hear from the committee if these are the right considerations or if there's others that we should be focused on. I'll quickly step through them.
We've had a collapse in several banks over the last week. We saw Signature Bank and we saw SVB, Silicon Valley Bank, collapse over the weekend, and I want to sit here and talk to you a little bit about what's going on and what is going on behind the scenes in these FDIC meetings. I made a video 2 months ago about some clips from an FDIC meeting. So these are like them talking about there are going to be issues with the banking system. There are going to be people worried about their money. There are going to be bank runs, or there's going to be a lot of this. So I posted this video, but there was also this video that came out, and this is a 3-hour and 28-minute video. I have not had time to go through it all. I just found this yesterday from my good friend 801XRP, posts a lot of good stuff. There's 2 clips here, one's 7 minutes and one's 5 minutes, okay? And I want to play these clips and try to help you understand what they're talking about here, because it is of crazy interest, okay? They talk a lot about large banks, systemically important banks, and what should happen if one of those should fail, okay? And if you don't know SIFI bank list, there's a lot of systemically important financial institutions globally. And, oh, come on, man, where's the list at? Maybe it's in Wikipedia. Okay, cool. So here you go. You have JP Morgan, you have Bank of America, Citigroup. The top of this list is the worst. These are the worst banks up top, and these are the more safer banks down below here. So Chase actually has $60 to $70 trillion in derivatives. Those are futures. And JP Morgan definitely is. But the one bank on this list that probably has the biggest issue right now is Credit Suisse. And if Credit Suisse were to fall, that could be catastrophic for the entire banking system. Okay, it's very fragile right now. And the Biden administration just got with the feds and they put together a $25 billion fund in case banks need liquidity, which is great. But the problem is much larger than $25 billion. And we'll talk about that in another video. But let's go ahead and get into these clips, and I'm going to help you try to better understand. I'm not a banking expert. I'm not a financial expert, but I do spend a lot of time researching all of this stuff. And so I'm going to do my best to play these clips and help you understand. Okay, let's go with the first one.
So I should just start by acknowledging that this is the first time that we're discussing a large bank resolution in the SRAC, and explain why we think it's the right time to do. The policy response to the great financial crisis understandably focused on the largest and most systemic institutions. At the same time, we at the FDIC have taken a number of meaningful steps to improve large bank resolvability and have long been attentive to the significant challenges that are posed by what are sometimes referred to as regional banks or DSIBs, but I'll just simply call them large banks.
Silicon Valley Bank was about $200 billion. They were considered a regional large bank.
For this discussion. While compared to GSIBs, the failure of a large bank might be
GSIB stands for globally important banking. GSIB, SIB, globally systemically important bank. GSIB, globally systemically important bank.
Relatively less threatening to financial stability. It still may be highly costly and result in significant disruption to local communities and potentially to the wider financial system, especially if it occurs in the context of a wider economic downturn.
So they're talking about if a big bank were to fail, and let's say that was the bank in that community that a lot of people banked at, that could be a serious problem for that community. That's what they were saying.
Our goal for this presentation is really simply just to introduce some of the challenges that we see with resolving these institutions and discuss some of the strategic options that might be available to us. During the global financial crisis, the FDIC handled the failure of the largest IDIs with creative and dynamic responses, but the options that were available to us were limited and undesirable, like a costly conservatorship in the case of IndyMac, and the sale of Washington Mutual to a GSIB, which was really only possible because it had a large pre-existing stock of long-term debt to absorb losses, and because it had already been marketing itself in the run-up to its failure, and so JP Morgan had conducted significant due diligence by the time the institution failed.
JP Morgan, I think, bought that institution at $2 a stock.
So it's fair to say that the challenges and tricky issues here are underexplored publicly and not fully resolved. I promise we won't resolve them in this discussion. We'll just get started. Really, on slide 14, just a quick flyover of the FDIC authority under which these institutions would be. The FDIC is the only regime available for resolving insured depository institutions. And importantly, the depositor class is senior to unsecured creditors, and the depositors, uninsured depositors, would share losses pari passu with the Deposit Insurance Fund, which covers insured depositors. Every resolution must pass the least cost test, which means that the FDIC must execute the resolution that is least costly, or a resolution that is least costly to the deposit insurance fund. So that really comes into play only when there are losses into the depositor class and therefore costs to the DIF in paying insured depositor. We have bridge authority, which would work a lot like the types of bridge authority that we've talked about in Title II, except that for an insured depository institution, it's a new deposit-taking entity chartered by the OCC.
Okay, so when a bank fails, like Silicon Valley Bank, they make a mirror copy of the bank. So the Fed comes in, they make a copy of the bank, and they move all the operations over to the new bank that the Fed is in control over, okay? And they need to bridge all of the employees and all the systemically important things of that bank. Think of a big globally bank like Chase or BNY Mellon or one of these guys, right? They have operations all over the world, right? They have branches, they have people working in different areas. And so all of those employees, or most of those employees, would need to be moved over to this new mirror bank, bridging them over. And that way the bank can continue normal operations while they're trying to figure all of this stuff out in the background. Because the worst part can happen is if a bank fails or becomes insolvent, the Fed's going to take over and they can't get the employees to help or continue with the banking regular day operations, and the bank completely collapses and everybody loses everything. So it's very important, this bridge over to this new mirror bank that is going to control all of the assets and try to get out of the situation, okay?
Than a company formed by the FDIC. I think it's well understood that the Deposit Insurance Fund is available to fund the costs of the resolution in terms of the administrative expenses during the course of the resolution, the payment of insurance, but really importantly for the resolution of large banks, which will almost certainly fail due to liquidity. The DIF is a source of...
Okay, listen to this. He's saying that other large banks could fail due to liquidity. I just want to rewind this a little bit and play that one more time because it sneaks up on you.
The administrative expenses during the course of the resolution, the payment of insurance, but really importantly for the resolution of large banks, which will almost certainly fail due to liquidity. The DIF is a source of temporary liquidity as well. It's large, pre-funded, but also backstopped by significant borrowing authority, ultimately by U.S. Treasury.
Okay, so what's happening here, what happened in Silicon Valley Bank is this. In 2020, 2021, there was a lot of stimulus money. So what happened was businesses and people especially got money from the government to stay at home because of COVID, or the C word. I don't think I'm supposed to say it on YouTube. But what happened is all those people took their money and brought it into the bank. And banks cannot hold a certain amount of cash on hand. They actually get fined for doing that. So what they go out and do is they buy treasury bills. And for Silicon Valley Bank in 2021, they did a 10-year treasury bill on like $21 billion. And it was only at a 1.8% return rate. And now bonds are like 4 or 5%. So people are going back down to the bank. They're taking their money out so they can go get better yearly returns on their money, right? If you're only earning 1.8% in Silicon Valley and someone else is offering you 4.5 or 5, of course you want that higher rate, right? Because that's easy, free money. And the bank had a run on cash, Silicon Valley did, and they had to sell their treasury bonds at a big loss, and that's what made them insolvent. That's how I understand what happened with Silicon Valley Bank.
The scale of the liquidity that we have in the DIF is actually in some ways greater than relative to the institutions that would be resolved, the order of liquidation fund entitled to significant liquidity that we can use to facilitate one of these resolutions. So moving to slide 15, just quickly, which institutions do we have in mind here? So generally, in this discussion, we're talking about IDIs with over $100 billion in assets that are not.
IDI stands for Insured Depository Institution is what IDI stands for, okay?
Subsidiaries of USG SIBs. But from a resolution strategy perspective, there's nothing magic that happens at that $100 billion line. There's nothing magic that happens at the $250 billion line. The issues are really similar. They just become more pronounced as the institutions get larger. Also, I think we find that large banks tend to be generalized as having a very simple structure, a holding company with 95% of all assets and activity in the IDI subsidiary conducting traditional banking activity. And part of the objective of this slide is just to Just to break down that mental model just a little bit. That holds for many institutions, but there's a little bit more complexity here than might at first be apparent. Some of these institutions, they obviously have more diversified businesses than smaller banks, and some of them even have Title I designated critical operation. And the first
a Title Designation 1 critical operations, these are systemically important banks, right? They are part of the clearing or settlement for international payments. They need to be there and working, or the kind of whole system breaks down, right? The systemically important bank is very important. And if one of them to break or crash or go under, that could be catastrophic for others that have maybe loans with this bank, or they're all interconnected, borrowing from each other and doing things. And so if when one goes down, it could be catastrophic for the others.
A couple of rows here focusing on the impact of size on strategy. And again, there's not much difference between over 250 and under 250. It's really a matter of degree and looking at how saleable are these institutions in a resolution. Very limited acquirers for any of the institutions in these categories. And really want to touch on the model line institutions if you think about it from a resolution strategy perspective. If they're failing, they have some specialized business that they're involved in, and it's almost sort of that's part of what's impaired, and that makes preserving franchise value through the course of the resolution significantly more difficult. And then it's just something that we tend to see with the institutions in that category. They have more operations outside the bank chain, making operational continuity more of a challenge for us in resolution. And then IDI subsidiaries of FBOs, similarly, operational continuity is a challenge as they have relationships with foreign affiliates, with the parent, in terms of shared services, shared data, shared personnel, those sorts of things. All right, so slide 16.
Okay. This is the most important slide. I want you to really listen here. This is one of the most important things you're going to hear about what they're going to do if a big bank fails.
These are some of the unique challenges that we see from a resolution perspective
this is
when considering large banks, and would be interested to hear from the committee if these are the right considerations or if there's others that we should be focused on. I'll quickly step through them. Here, we're distinguishing the large bank resolution both from GSIB resolution under Title II, but also from the resolution of ordinary community banks. And in a way, they combine a lot of the toughest challenges of each, plus the burden of high expectations. I think everybody's going to remember the challenges with failing SIFIs from the global financial crisis. But for large banks, the expectations are probably closer to the failure of an ordinary bank that the FDIC tends to handle routinely and swiftly.
All right, so there's the second clip here. Let's finish this off because he's talking about this. It's really important. It's a longer video, but it's worth it, guys. Let's just listen.
There's others that we should be focused on. I'll quickly step through them. Here, we're distinguishing the large bank resolution both from GSIB resolution under Title II, but also from the resolution of ordinary community banks. And in a way, they combine a lot of the toughest challenges of each, plus the burden of high expectations. I think everybody's going to remember the challenges with failing SIFIs.
So they're talking about if something like Chase or Credit Suisse were to fail, a lot of people have money in those banks and a lot of people have confidence in those banks. And they're talking about how all that's going to play out with those customers, those businesses, and those people that have loans and everything.
From the global financial crisis. But for large banks, the expectations are probably closer to the failure of an ordinary bank that the FDIC tends to handle routinely and swiftly. So just starting the challenges box, the first few here, generally speaking, relate to strategic options, and the latter get into operational challenges just in carrying out the resolution. But obviously, as touched on already, just from the standpoint of capacity, the capital and operational resources that would be needed, there are very few institutions that could acquire a large bank. And it'll be especially difficult at the time of failure on a compressed timeline.
So they're talking about if a big bank fails, their ability to try to sell the bank, because the Fed takes over, but the Fed's not there to be there permanently. They're there to try to get the assets and the bank into somebody else's hands. But if a $250, $300 billion, $400 billion, $500 billion bank fail, there's not many institutions or businesses or whatever that could acquire that bank and all of those assets, because that's a lot of money. So that's what he's talking about there.
There's no minimum loss absorbency requirement for these institutions. Some of them do have long-term debt that could absorb losses, but there's no requirement. And that means that there could be increased costs, and that could limit the strategic options available to the FDIC, particularly if the depositor class is impaired. Franchise value might be destroyed, and it might make it harder for bridge and sale strategies to pass the least cost test.
Yeah, I think that was pretty explainable right there.
They don't have a debt structure that supports a single point of entry type of resolution that's sometimes contemplated for these institutions. But without that structure there, that means entry at the IDI, which is for these institutions a very complex operating company. If we're using a bridge, that means that over the weekend, it'll involve the transfer of thousands of employees and a wide array of services, assets, and contracts to that bridge institution over the. I've noted the challenges with operational continuity in addition to services being outside the bank itself. They also just haven't fully addressed the impediments to the operational continuity and resolution that some of the larger firms have, and to the same degree. So the next handful of challenges here, I know there are a lot of challenges, which is part of the message.
It gets better.
Get into the receivership entity itself. There's a large number of deposit accounts that we would need to handle at the time of resolution for the largest bank, 10, 20, up to 40 million deposit accounts, and more complex account types than for smaller banks. Past the relationships and things like that would be harder to work through. And then, of course, large portions of the deposit.
So past relationships are talking about the banking C class, or the people that run the bank. They have connections that help fuel the bank, loans, and different business connections. And if the bank were to fail, some of those people might not go over to the bridge or mirror bank, and they wouldn't have those connections in different countries around the world. That's what he's talking about there.
Balances are uninsured, ranging from 40 to 50% for these institutions.
This was the most important part, and I stopped at the wrong time. I'm sorry.
And then,
let's play back this.
Things like that would be harder to work through. And then, of course, large portions of the deposit balances are uninsured, ranging from 40 to 50% for these institutions.
Okay. Excuse me. So the fund that the feds put together has $25 billion in it. He just said that 40 to 50% of depositors are uninsured. Okay. So if the bank has $200 billion or $300 billion, right? And 40 to 50% of it is insured, but 40 to 50% of it's not insured. What do we have? We have hundreds of billions of dollars of lost money, right? And those could be derivative products, which are futures. Those could be other people that have different loans that might be uninsured, but over half the people would not get their money back. That's important. That's really important. It's really important. I'll give you some suggestions after this video on how I am trying to resolve what I'm going to do with my money. Okay, let me finish
on average, and then just other challenges around receivership management, the receivership entity that the FDIC would be responsible. It'll depend largely on the complexity of the complexity and scale of the assets that are left behind in the receivership. It could be significantly simplified if we're selling the institution or using a bridge, and much is moving to that. I should just note that in the event that we have to undertake a liquidation where everything stays in the receivership, the operational challenge is quite daunting in that circumstance. The last two challenges here touch on the path to failure and the point of failure. They have more complex business lines, and the fact that we're going to need to make projections about valuations through the course of a bridge period makes our assessment of the potential cost of resolution at the time of failure more difficult. And then combine that with the fact that they're almost certainly going to fail due to a run on liquidity. There'll be an abbreviated runway, which will further reduce the time that we have to conduct valuations and to market the institution. So those are the challenges. There are a few advantages. Importantly, as was touched on in the first panel, we maintain a dedicated on-site presence at these institutions. It's hugely valuable in understanding these companies day to day. And then also in the runway to resolution, when one of these banks fails, we'll have ready access to the sorts of technical information that we need to be prepared to resolve one of them. We maintain 2 resolution-specific record-keeping requirements that relate to large bank resolution. One requires these banks to be able to calculate deposit insurance within 24 hours, notice from the FDIC, and provide that to us within 24 hours. And another.
So in 24 hours of the bank failing, the bank has to give the FDIC a report on who's insured and who's not insured, their money.
Requires certain of these institutions to provide us with position level QFC data so that we can.
QFC data. Did I have that one? QFC data. No. So QFC data banking. I can't remember what it stands for. It stands for qualified financial contract. Qualified financial contract. Finish this off. There's only 30 seconds.
Assess their derivatives portfolio, make decisions in a timely way over a resolution weekend. And then, of course, we have an IDI specific resolution planning, which increasingly involves not just the plan submission, but engagement around the planning process with the institutions on an ongoing basis. So that's a lot. I'll stop there, and I'm interested for any.
There's 3 hours and 28 minutes of this meeting. I'm going to watch the full thing today, and I'll have other clips of this. There's only, like 12 minutes of 3 hours and 20 minutes. There's a lot more to watch, a lot more to report on, and I'm going to do my best to get the information to this channel and to you. What I am doing personally is making sure that whatever I have in my account is under $250,000. If it's multiple accounts and multiple banks, I reached out. That's exactly what I would suggest to a family member that is maybe thinking about this. And also understand that if you're betting on futures and your bank fails, you might not be covered. Where you bank and who you bank with is very important. JP Morgan has probably the highest risk, but Credit Suisse is probably the systemically important bank that I think that could fail next. We will see what happens. If it does fail, I will be here to report and give you information on it. I hope this was helpful, guys. Please, and share with somebody. This is super important, and this could save somebody's well-being in life or their retirement. So share with somebody you know.